It generally makes sense to convert it right away anyway, because if you put after-tax money into your 401k plan and then it grows, the growth on it becomes taxable. Whereas if you had converted it and put it into a Roth, then the growth is tax-free. So generally it makes sense to convert it right away, even after contribution. But for some people, they either don't do it or whatever the case may be. But this may be your last chance here before 12/31.
Welcome to Retire Smarter with Kevin Krosky. Find answers to your toughest questions and get educated about the financial world. It's time to retire smarter.
Glad you're with us today on Retire Smarter. I'm Walter Storholt alongside Kevin Krosky, President and Wealth Advisor at True Wealth Design, serving you in Northeast Ohio, the greater Pittsburgh area, and down to Southwest Florida. You can find us online at truewealthdesign.com and click the Are We Right For You button to schedule a time to chat with an experienced financial advisor on the team. You can also call 855-TWD-PLAN to get in touch, and we'll put that contact info in the description of today's show. Kevin, great to be with you on the program today. How you been?
Well, I'm good, buddy. My oldest just had her 8th birthday, so we have an 8-year-old
A big 8
in the household. Yes,
Nice.
8 is great. 8's her favorite number, so it's going to be a big year for her. And she's, I think my wife is more than making up for childhood that she wished she had, and she has had a fantastic birthday week. But I asked her. Aubrey's her name, and I asked her. I said, I wanted to do something just the two of us, and gave her some choices, and she actually chose to go to a Pittsburgh Steelers game. I was like, oh my gosh, I do love you.
Oh my goodness.
So I took, the game.
There must have been some under the table bribing happening here, right?
Zero.
On behalf of Dad? No, not
zero. I mean, she's, we dress up on Sundays. We have fun. I've taught her the Steelers are good and the other teams are bad, of course, as any good fan would do. But we went to the game.
Yeah, especially this season. That's true.
Right. Yeah. Yeah. Yes. By the time this airs, I'm kind of scared to see what the Steelers record looks like. But, what are you going to do? So the cool thing was, they did not win the game that we went to, but she was actually on the Jumbotron at the stadium. So she was
That's
over
great.
the moon. Like, I wasn't on it. The cameraman at the angle got her, and I took my brother-in-law, her uncle, and they got the two of them, but she was there just, as cute as can be, shaking her Pittsburgh Steelers terrible towel, and she was just over the moon about it. So it was a fantastic experience, even with the Steelers losing, just to do that with her was awesome.
That is really cool. What a great experience for her. And do you think that'll be a wish for her 9th birthday as well? Can that become an annual birthday wish?
She had fun. There was, we were there for a while. I think she got a little bored at times, and the stadium was, I don't want to say it wasn't that close of a game. It was a better game. Maybe it would have been a little bit more engaging, but it was a lot for her to sit through. On balance, she had fun. I think she would want to do it again. But our younger daughter turned 3 in August, and so maybe next year, maybe all 4 of us can go together. So we'll see. But Daddy will be tuning in on Sundays. Well, one other quick aside. So I was listening to the game on talk radio, going to the game, and she's like, "But Daddy, we're going to watch the game. Why are you listening to them talk about the game?" And then after the game on the way home, I'm listening to the breakdown of the game. She's like, "Daddy, you just watched the game. Now you still listen to them talk about the game." It's like the game inside the game inside the game. But yeah.
That's pretty funny. Yes, I can imagine that being to an 8-year-old being like, whoa, hold on. We just were at this thing. Why are you, you saw it with your own eyes. What do you need the analysis of someone else for?
Right.
You'll understand later. Oh, that's too good. Well, glad you guys had a great time. And I'm glad it was a great experience overall. And congratulations to Aubrey on hitting the big 8 years old. Fantastic. Well, we've got a fantastic show on the way today. Not as fun as going to a Pittsburgh Steelers game, I'm sure, but I think it'll be informative and pretty interesting to hear your perspective on this, Kevin, because we're talking about Biden's American Families Tax Plan. Finally, things have gotten into motion and started happening here, and you're here to break down some of the key changes. And as always, you're looking for opportunities where there might be problems or bumps in the road, and can't wait to hear your breakdown of everything.
Yeah, you got it. So it's, I guess first and foremost, it's not law yet. So this was a proposal that came out on September 13th. And it is actually, kind of a tax proposal that came out of the House and Ways and Means Committee. So this is kind of the starting point in the sausage making process. And I'm sure there'll be a few changes before it becomes law. But, ultimately, a lot of the things we're going to talk about today, I think, are very likely to happen. So it makes sense to start thinking about it. And we'll just really talk about individuals today. There's some things for individuals, for businesses, estates, and trusts, and so on and so forth. But this is really just more for individual income tax planning. And I think the big thing to take away is it's not nearly as bad, or as punitive, maybe a more accurate word, bad and good, or maybe more subjective, but it's not nearly as punitive as what was originally discussed. So I think that's pretty good in my subjective view. But I'll put this into, say, 3 buckets. We'll talk about, and I will use these subjective phrases. I'll use bad, good, and then things that didn't make it into the bill. And we'll talk about, what really is there, and maybe some things that we should start doing or keep doing for that matter. But in terms of the bad, and this isn't necessarily a huge thing, but the top marginal tax rate used to be 39.6 when Obama was in office. It got reduced down to 37. It was already scheduled to go back to 39.6 in 2026. It's just moving it up more quickly to 2022. So not a huge increase there, just a little less than 3%. But coupled with that, the brackets are more compressed for this top rate. So the top of the 37% bracket used to start at about $630,000 of taxable income if you're married filing jointly. Now it starts at $450,000. So higher rate, but also starting on a lower dollar amount. So there you have it for the income main tax increase. For capital gains tax, so there was a lot of talk about couple things happening with capital gains. Going to ordinary income if you're in the top tax bracket, or if your income was more than $1 million, which is obviously not quite a big number. But that didn't happen. The increase really went from 20% top capital gains rate to 25%, starting at that $450,000 taxable income level. So again, really only applicable to those that are in the top tax bracket, which was really something that Biden stated before. Hey, if your income is below 400,000, you're not going to see an increase. So you're kind of seeing a theme here in that regard. So those were the two, I would say, big changes, the more the punitive, or AKA bad, if you're in that bracket and subject to those increases. Some of the things that also are going to be more widespread. So if the new tax law prohibits conversions, so moving money to a Roth IRA, converting that money of after-tax amounts. So this applies to both IRAs as well as 401ks. So for many, many years, let me back up for a moment. So when it comes to the Roth, there's really kind of 2 C words to be mindful of. You can contribute to it, or you can convert money to it. If your income is high enough, then that contribution is not permitted. So one of the ways to get around that was something called a backdoor Roth IRA. And if you say all your money was in the 401k, you could put money into a traditional IRA, not take a tax deduction for it because your income's too high and you're participating in your 401k and no tax deduction is allowed. But now you have this after-tax money in the IRA. And if you want to go ahead and convert that to a Roth, well, there's very de minimis to zero taxable income to do it. So it was a bit of a backdoor, thus the name, backdoor Roth IRA. So that would now be precluded from happening. And then also there was something as it related to 401k plans, the mega backdoor Roth IRA. This is where you could put in, on a pre-tax basis this year, under age 50, you could put in $19,500. But if your plan permitted it, you could put additional after-tax contributions into the plan, as much as, I think the number is about $58,000 total this year between all defined contributions going into those plans. So you could have a sizable amount of money, of after-tax money, over and above that 19.5 going into this bucket. And then you could convert that over into a Roth IRA. So both of those conversions, the backdoor Roth is gone, and the mega backdoor Roth, I won't say is, but is likely to be gone. I think this is going to be one of those things that's going to stick. And then one other mention on the conversions. So for everybody back in those top tax brackets, so again, 450,000 plus taxable income if you're married filing jointly, no more Roth conversions for you, but that starts in about 10 years. I think, some of this, there's a lot more spending in some places, and they're trying to offset some of that spending. And the reason why they did this for 10 years, I believe anyway, I'm speculating, but the CBO scores this over a 10-year period, and they're pushing this out to year 11, basically saying that, hey, go ahead and keep doing the conversions for the next 10 years and pay us those taxes as you move the money from pre-tax IRA or 401k over to the Roth, because we need that tax revenue to make our plan work and the CBO to score it the way that we need them to do it. So kind of a lot. Let me take a pause there. Walt, any questions on anything I just shared?
No, I think all that makes sense. It's interesting with the backdoor Roth option going away. I can see that seems like the thing that might affect the most people out of this section of things that are bad, perhaps?
Yeah, I would say so. If I think of our client base, yes, we have, several handfuls of people that have these backdoor Roths. My wife and I can be included in that. Typically, not always, but typically it tends to be a little bit younger, kind of certainly still working, higher income people that can just go ahead and do this. You can't really have money in IRA accounts. There's something called the aggregation rule where, if you have, say, a rollover from a prior employer, maybe it's $100,000, and you try to put in $6,000 into an IRA that's not deductible and convert it, well, all those dollars are aggregated together. So it's not just the $6,000 you put in that you move over. It's actually a ratio, the 6,000 divided by 106,000. So it's called the aggregation rule. Some people explain it as the cream in the coffee. After you put the cream in the coffee and stir it up, it really doesn't separate. So you have to have certain traits to do it and do it correctly. But yes, it's definitely the most broadly applicable item, and it's likely to be gone. I think there's broad support for it.
I mean, I'm all for making things simpler in terms of, I'd prefer not having backdoor options and those kinds of things. Just personal preference. Just give me the basic rules, but at the same time, make it easier for everybody to figure out what they need to do. I don't know. Sometimes I feel like we overcomplicate these things, but.
Yes, for sure. And then there's people like myself, and we'll look at the rules and we'll try to plan. We're not going to evade
I'm not
taxes.
blaming you for taking advantage of it by any stretch. No. Absolutely, but
yeah, no, I get it. And candidly, I mean, the tax code was simplified a great deal with the 17 reform, with the standard deduction being what it is,
right.
Being significantly higher. Many fewer people are itemizing. Your return preparation has gotten simpler. So in general, it's moved that direction. But there's always going to be, anytime you're going to have something that's black and white, you're always going to find people trying to find the gray in there, and some people more aggressively than others. And I mean, it's kind of a never ending thing. And whatever sort of simplification they're going to have, there's going to be some other ideas that come up and become tested over time about how to get around it.
And that is kind of fun to do for somebody in your position, I would imagine, looking for those areas where you can test it a little bit.
We all should pay our fair share, Walt, but we don't have to leave a tip, so to say.
That's
yes.
right. I like that.
So that's everything that I have in the quote unquote bad. Well, actually, one other. There is, and this is one of the lesser known ones there, but if anybody's doing any sort of private investment, oftentimes this could be some sort of form of real estate, or investing in an operating business that's not publicly traded. So a private placement, typically you have to be an accredited investor to do these things. It's something that we use for our accredited investor clients from time to time because we feel like it makes sense and we like the risk and return attributes of it. But the legislation actually prohibits IRAs from owning any security with income, asset, or licensing requirements. So to be an accredited investor, go from memory here, but I think it's $1 million liquid, excluding the net worth of your home. Or, like if you're a married couple filing joint, you had to have $300,000 in income the last 2 years. So there you have, income or asset requirements to be an accredited investor. Thus, it would go ahead and preclude those sorts of investments coming into the IRA. So we'll see if that sticks. I haven't really heard any comments on that one way or the other, but there's been a couple cases of Silicon Valley people putting these sorts of private investments inside of their IRAs and building an exorbitant amount of wealth inside of them. And there's some different
was this kind of like that. What was it, Peter Thiel, with how he became a
I think
billionaire inside of his IRA?
I don't know if I think it's like, I am going completely from memory here, but I thought it was like maybe 50 million in an IRA or something. And we're not going to get into it today, but there are some provisions probably specifically for him and his Silicon Valley buddies that apply once your IRA gets over like $10 million or something. Mitt Romney was another one when he was running for president. His IRA was, I think, $20 or $30 million. Peter Thiel, though, his was in a Roth. Mitt Romney's was in a taxable IRA. So Mitt Romney's going to be paying through the nose for income taxes. Peter Thiel, and I think that's who it was, tax-free forever in his Roth. So big planning difference there. Good job, Peter Thiel. Not so good for Mitt. But nonetheless, two examples of creating significant wealth through a private company or a limited partnership interest like that through the IRAs, whether pre-tax or Roth. So those are all things I'll kind of subjectively put under the bad. If we switch over to the good, two things here. So the child tax credit, there's been a big increase in the child tax credit this year in 21. That's being extended through 2025 to the tune of $3,000 per child for 6 and older, and $300 per month per child for those 6 and under. Under the age of 6. So 6 and older, and then under the age of 6. And that does start phasing out as your income gets higher. So if you're single, it starts phasing out at $75,000. If you're married filing jointly, it starts phasing out at $150,000. So that's happening now. It's really impacted a lot of people that have kids, 18 or under, and that's looking to be extended. So that's certainly something on the spending side. And then also, and something that's more appropriate for the listeners here, the healthcare tax credit. So I mentioned whenever the third round of the stimulus plan came out in March of this year, that the healthcare tax credit was changed such that it didn't really matter what your income level was any longer. So previously it used to be that, hey, if you are just a household size of 2 and your income was more than 400% of the federal poverty line, which round numbers, it was about $70,000 of income hitting your tax return. So say you're 63, you're not on Medicare yet, but you're retired and you have to go get healthcare through Obamacare, through these exchanges. Well, before, if your income was, say, maybe $100,000, then, you're kind of SOL and no healthcare tax credit for you. We have several clients that are like that, and they're paying, maybe $20,000, $25,000 a year for healthcare. Well, with, I can't remember what it was called in March, but it was American something or other, American Rescue Plan, or it was stimulus number 3, basically. It was the third time they sent the checks out. But that was changed, and so that 400% cap of the federal poverty line was removed. And they actually lowered something else that goes into that equation. But so I'll give it a simple example. Let's say that your adjusted gross income is $100,000 hitting your tax return. And the cap is, well, your healthcare can be no more than 8.5% of your AGI, your adjusted gross income. So 100,000 times 8.5% is $8,500. When we get too wonky here, it references, something else, kind of the second lowest cost silver plan in your market. But if I go back to that client example that's paying north of $20,000 per year, and now this new change is saying, hey, you're capped at basically 8.5% of your AGI. And you can see there's more than
$10,000. That's some nice money back in the pocket.
That's a huge money back in the pocket. And that, it applies to a fairly small swath of people. In my view, I don't know exactly on the statistics, but just from my practical experience, because if you're working, more likely than not, you're on the employer's healthcare plan, unless it's a really small employer without health insurance. But it's really for those people, I would say, that are kind of a bridge to retirement. You had a lot of talk, particularly from the more liberal portions of the Democratic Party, that they wanted Medicare for all, kind of take it down to age 60, so on and so forth. I would say this is kind of a way to almost get them what they want without exactly doing just that. They're making it more affordable, giving a more of a health care tax credit for those people. So we'll see if it gets passed and where it ends up. But we have several clients where that's going to be, big change, big news for them, and really change our planning strategies. I mean, it's something that we've been doing. We've done podcasts on this before. Tax smart distribution planning, I remember, was one we did probably about 2 years ago in the fourth quarter when we were going through that process for clients. And we talked about this very thing. I think we actually did one last year too, Walter. And the title was how to get like a $16,000 tax credit under Obamacare, even if you're wealthy. Well, it's gotten more generous. And so it's something that we can definitely plan for and avail ourselves of. We'll see if it does get extended through 2025. Actually, I check that. It makes permanent, was the language. Makes permanent. So that's not extended through 25 like the child tax credit, but at least the initial proposal made it permanent. So we'll see where that ends up. But for our pre-retirees and our early retirees before 65, huge news there. Really, really important piece of information and planning information to be mindful of.
Well, we didn't spend as many minutes talking about the good, but for those who fall into that band of improved areas with the child tax credit and that health care benefit, that is huge news for those folks. So fantastic. Even though we know the word permanent doesn't really exist in,
right.
in government, right? So.
Good observation. Yes, you got it.
So is there maybe the biggest news that there was a lot of stuff that didn't make it to the bill?
Yeah, I guess it depends on where you kind of fall on the income charts, but
Okay.
some of the things that were talked about that did not and were proposed initially through Biden's tax plan, but did not end up in the House Ways and Means proposal. So there was talk about currently when you pass away, if you have an investment account that has grown in value or have a capital gain, when upon your passing, that capital gain is stepped up to your date of death value, or something called an alternate valuation date that you can do through your estate planning. But that was talked about being eliminated if your net worth, your estate was of a certain size, and it would actually apply to a lot of our clients. That did not make it into the proposal. So the current law, at least as it is written, looks to be standing there. So the capital gains will still continue to get a step up in basis at death. So that does apply for certain things, like not only just estate planning, but we've talked about asset location before. It's a whole kind of wonky subject, but that definitely applies into like us picking which assets we're going to put into a certain type of account, predominantly into like a trust account or joint account or non-qualified account, and what we would sell as part of a tax smart distribution plan or not sell. So even though that's an estate planning item, that still does have ramifications over the investment and the retirement income planning. Again, all these things are kind of like dominoes, and you pull on one and it kind of pushes over two more. The other thing that didn't end up in here was really for those really high income earners, million plus. The capital gains were supposed to go to and be equivalent to the top ordinary income rate, a 39.6. Again, they're being proposed to go from 20 to 25%. So that's a far cry from being nearly 40%. So if you were fortunate to be in that group, you're probably doing a little bit of a happy dance right now, because you most certainly have some capital gains outside of your IRA and those types of non-qualified accounts.
So they're still impacted by the increase. It's just not as much, but then the income level of who that impacts is lower. So it's more people impacted, but not as big of an increase as the original proposal.
You got it.
Okay.
And it's, and candidly, I mean, we had a rate like this back when Clinton was in office. It was, I think, a 28% rate. And then they had some tax reform in the late 90s that reduced that rate. So, it's going from 20 to 25. Again, I mean, I don't see it as a big deal. We'll certainly be mindful of it. We'll need to plan around it, but we're already doing the things to minimize any sort of tax drag on our taxable account that has the capital gains anyway. You don't have capital gains in your IRA. Your IRA is it's a pre-tax account. It's going to be fully taxable when it's pulled out, or if it's a Roth, it's never going to be taxed. So we're really just talking about those accounts under the umbrella that we call a non-qualified account. So whether it's an individual account, a TOD or transfer on death account, a trust account, a joint account, things along those lines. So that would...
Alert.
I'm sorry. Had to do it. You used too many abbreviations, dates, and percentages all in one sentence. It triggered
System
the egghead
overload.
alert. Yeah, system overload.
It's been a while. I kind of missed that, Walter. Thank you for that.
I had queued it up today. I had it ready for you. I figured talking about taxes and on our previous episode, Social Security, we were going to trigger it at some point.
We sure did. All right. Bring me back down to Humanville. So two of the other things I'll mention that didn't end up in here, again, Biden always kind of talked about, hey, if your income's over 400,000, actually the way I think he phrased it says if your income's below 400, it's not going to get changed. And he didn't say this, but he kind of implied if you're over 400, you're screwed. So you're not being as punitively punished as what he originally said. And part of that too was with payroll taxes. We work with a lot of younger physicians that, are making good income, and certainly they're doing well, but they do pay a lot in taxes. And basically the cap on what they pay for payroll taxes was talked about being removed, at least over a certain income threshold. And that was partly going to be part of the Social Security fix, but that did not end up in the plan. And then one final thing, salt, not the type that you put on your food at dinner, but the state and local tax deduction. So I already mentioned, hey, we're all generally availing ourselves of this higher standard deduction. It's nearly $27,000 this year for a married couple filing joint. But you're capped at only $10,000 of state and local taxes. So property taxes, local income taxes, state income taxes, only $10,000. So many of our clients are capped out at the $10,000. And that precludes them from itemizing and getting over that standard deduction. So in Ohio, we're not as bad. It's really the higher income tax states, the New Yorks, New Jerseys, Californias, Massachusetts, where this is more of an issue. When we went through 2018 tax year, we had a lot of people that pay a lot of SALT taxes, and we thought there may have been some that would actually be worse off under the tax reform bill that we had. And we had a couple that were close, but actually we had 0 people that were worse off from it. So it's really state dependent, but that did not end up in the bill. So I won't make any comments to it, but those were a few of the key things that were talked about potentially being in the bill that did not make it.
Okay. Any to-do items that come out of all this information? I know that it's not exactly law yet, so maybe don't go pull the trigger on, some actionable item just yet, but what should we have our eyes out for?
Yeah, well, I think the thing that's likely to change, as the sausage gets made, a lot of the things we talked about, and I specifically pulled them out, I think are likely to stick. It's probably some of the things in the business side that are, I think, a little bit more fluid, where the business tax rates are and some of the changes there. But we'll see how the sausage gets made. But I think one of the key things that I will reiterate, if you're a married couple filing jointly, this year you can have up to $330,000 of taxable income and still pay only a 24% tax rate. You go back to 2017, you were hitting a 25% tax rate at about $75,000 of taxable income. So not only is the rate lower, a smidge, but the brackets are way, way wider. And that's still the same. I mentioned for these higher income taxpayers that maybe conversions are going to be going away at some point, but that's 10 years plus down the road. So we can continue to avail ourselves of these lower tax brackets through conversions, through just smart tax planning, whether you're still working or you are in retirement. So that's huge. So still only a 24% rate all the way up to $330,000 of taxable income, and you can still do conversions.
Can I ask a clarifying question on the conversions?
Absolutely.
That includes the backdoor Roth options that you're talking about, right? So that, although you're pretty much, you feel guaranteed that is going away, that's also included in that, but it's 10 years from now.
No.
Okay.
No. Yeah. All of the after-tax money being converted goes away in 2022. So if you have after-tax money in your 401k, you should really be looking at that this fourth quarter and seeing if you can get it out of there and convert it into a Roth. It's a pretty technical area. If this applies to you, we have a couple clients we're going to be having conversations with in the fourth quarter. It generally makes sense to convert it right away anyway, because if you put after-tax money into your 401k plan and then it grows, the growth on it becomes taxable. Whereas if you had converted it and put it into a Roth, then the growth is tax-free. So generally it makes sense to convert it right away, even after contribution. But for some people, they either don't do it or whatever the case may be. But this may be your last chance here before 12/31. So that's huge. If that applies to you, very, very big item. If you have after-tax money in your plan, definitely need to look at that before year-end and probably convert it to a Roth. It may or may not be possible. It depends on your plan, and it takes some time to really dig through that. So if that applies to you, make sure you talk to somebody that's competent and knowledgeable about this. The other thing I would mention is, again, that huge healthcare tax credit. It's being quote unquote permanently done. We'll see where it ends up for sure. I think this is going to be something that sticks. It still applies this year regardless of this bill. It was part of that stimulus number 3 that I mentioned, but that is really going to impact some of the tax planning that we're going to do over the next several years. One practical implication of that is, if we were going to avail ourselves of that tax benefit, then we couldn't do as many dollars converted into a Roth IRA, because pulling money out of the traditional IRA would increase our income. And if we went over the 400% of the federal poverty line, round numbers, about $70,000 for a household size of 2, then they're bye-bye tax credit. Now that's gone. So now we can have a little bit more flexibility to do a blend of both healthcare tax credit and conversions, and at least do the math and see what makes sense there for everybody. So that's definitely big. And then, if you're in that $400,000 to $600,000 taxable income range, candidly, it's hitting you more than most, because not only are the rates higher, but the brackets move lower. So that top tax rate is applying at a lower dollar of taxable income threshold. So if you have flexibility over income, these rates are scheduled to be in effect in 2022. Capital gains are actually scheduled to be in effect as of September 14th, the day after this legislation was proposed. But if you can accelerate income into 2021, whether be it for a bonus or if you are a business owner and have some flexibility there, probably a good thing to consider before the end of the year.
All right, very good. And nice little breakdown of all of these different proposed changes, what made the plan, what did not, and some analysis there. If you have questions about this, please reach out to Kevin and the team at True Wealth Design. You can do that by going to truewealthdesign.com, click the Are We Right For You button, and schedule a 15-minute call with an experienced advisor on the True Wealth team. You can also check our description or the show notes section of today's program for that link and contact information. And the phone number to call if you have questions and want to reach out that way, 855-TWD-PLAN. 855-TWD-PLAN is the number to dial. Kevin, thanks for the help, guidance on today's show, and the breakdown of all the taxes and all that good stuff. Holidays are around the corner, November, December on tap. Looking forward to what you'll have for us on the next couple of episodes.
Yeah, likewise. Well, we should have some finalization of this too. So definitely need to start thinking about it now, start getting your ducks in a row, as they say, and we'll give an update once we have one.
Yep, 2021 almost over. So make those good choices and get going if you need to make something happen before the end of the year. For Kevin Krosky, I'm Walter Storholt. We will talk to you next time, right back here on Retire Smarter. Thanks for listening.
Information provided is for informational purposes only and does not constitute investment, tax, or legal advice. Information is obtained from sources that are deemed to be reliable, but their accurateness and completeness cannot be guaranteed. All performance reference is historical and not an indication of future results. Benchmark indices are hypothetical and do not include any investment fees.